You saw the number, 43% returns, 1 year, and the person showing it to you was calm, professional, and had a track record going back 5 years. So you moved your money in. Warren Buffett calls this by far the best book on investing ever written, and Chapter 9 exists for one reason, to explain exactly what happened next. Benjamin Graham had a name for that calm professional manager with a 5-year track record. He called them miracle workers, not as a compliment, as a warning, because he had watched the same person appear in every generation. Different name, different font, different story, and every single time the same ending. Losses, not small ones. He used the word calamitous. If you have ever moved money toward a number on a page, or felt the pull to, this chapter was written for that moment. Hi, I am Nick, the guy with a Greek accent and a long-time value investor. This series is what I wish I had before I learned these lessons the hard way. Plain English, just the intelligent investor translated, so you can actually use it. If you are new here, subscribe and start from video 1 of the series. Graham writes, "We are quite certain that the funds in the aggregate have served a useful purpose. They have promoted good habits of saving and investment. They have protected countless individuals against costly mistakes in the stock market. The average individual who put his money exclusively in investment fund shares in the past 10 years has fared better than the average person who made his common stock purchases directly. The average person doing the average thing, putting money into funds, did better than the average person trying to do it themselves. Not because fund managers are brilliant, but because funds kept ordinary investors away from their own worst instincts. The fund kept you away from hot tips, panic selling, and every new offering that promised to change everything. It was the guardrail, and for most people, the guardrail worked. The average individual who opens a brokerage account with the idea of making conservative common stock investments is likely to find himself beset by untoward influences in the direction of speculation and speculative losses. These temptations should be much less for the mutual fund buyer. You open an account with good intentions, conservative investments, long-term thinking, and then the machine goes to work on you. The broker who calls with a tip, the new offering that everyone is getting into, the stock that just moved 40% and feels like it has more room to run. The brokerage account is not a neutral tool. It is an environment designed to generate activity, and activity generates fees, your fees. The mutual fund buyer is insulated from most of that. One decision, which fund to buy, replaces 1,000 smaller decisions that could each go wrong. So Graham's starting point is clear. For the average person, funds are not a compromise. They are a rational choice, a better outcome than most people achieve on their own. But here is where most fund investors stop thinking. They assume that because a professional is managing their money, that professional must be able to do something they cannot, beat the market. Graham dismantles this quietly with a single observation. The combined decisions of these professionals pretty well determine the movements of the stock averages, and that the movement of the stock averages pretty well determines the fund's aggregate results. The professionals are not watching the market from the outside, waiting to outsmart it. They are the market. Their collective buying and selling is what moves the averages. And if their decisions create the market's movements, they cannot, as a group, consistently beat those same movements. It is not a failure of skill. It is a mathematical impossibility. If every professional is trying to beat an average that they themselves are creating, most of them will land exactly at that average before fees. After fees, most will fall behind it. This does not mean funds are useless. Graham already told us they are better than the alternative for most people. It means that the promise of consistent, market-beating performance is not just unlikely. It is, by definition, something only a minority can ever deliver. And identifying that minority in advance is harder than most investors assume. So, if beating the market is not a realistic expectation, what should you actually be looking for in a fund? First, you need to know that there are two types of funds. The first type is what most people mean when they say mutual fund. You give them your money, they give you shares, and the price you pay always reflects exactly what the fund's investments are worth, no more, no less. These are called open-end funds. The second type works differently. A closed-end fund issues a fixed number of shares, and those shares then trade on the stock exchange, just like shares of Apple or any other company. And because they trade like stocks, their price is set by supply and demand, not by what the underlying assets are actually worth. Here is why that matters. Sometimes those shares trade at a premium. You pay more than the fund is actually worth. Sometimes they trade at a discount. You pay less. And when they trade at a discount, you are buying a dollar's worth of assets for 80 or 90 cents. Here is a real example. The Adams Diversified Equity Fund, ticker ADX, has traded at a discount to its underlying assets for most of its history. At various points, you could buy a portfolio of large American companies, the same companies sitting inside the S&P 500, for 85 cents on the dollar, simply because the market priced the shares low that day. Graham's entire point made visible in a single ticker. Graham writes, if you want to put money in investment funds, buy a group of closed-end shares at a discount of say 10 to 15% from asset value, instead of paying a premium of about 9% above asset value for shares of an open-end company. You will thus obtain about 1/5 more for your money from the closed-end shares. 1/5 more. Same assets, same dividends, same fund manager, just a better price. No forecasting required, no analyst, no special knowledge, just the discipline to look for the discount and buy it when it is there. Now we get to the trap that catches most beginners. It is the fund that just had a spectacular year. You see the number, 40% returns, 60%, sometimes more. And the person selling it to you is confident, articulate, and has the charts to prove it. Graham saw this person too. Bright, energetic people, usually quite young, have promised to perform miracles with other people's money since time immemorial. They have usually been able to do it for a while, and they have inevitably brought losses to their public in the end. Since time immemorial, Graham is not describing a modern problem. He is describing something permanent about human nature and about the nature of money. The miracle worker appears in every generation. The story changes, the outcome doesn't, and here is the mechanism behind it. All financial experience up to now indicates that large funds, soundly managed, can produce at best only slightly better than average results over the years. If they are unsoundly managed, they can produce spectacular but largely illusory profits for a while, followed inevitably by calamitous losses. The profits were real enough to attract your money, illusory enough that they could not last, and when they ended, the losses were not small, they were calamitous. When I first decided to invest my first $1,000, I walked into a local bank to open a brokerage account. I wanted to start selecting stocks. I asked the employee if he knew any books I could read to learn. He said, "Sure, Nick, I'll be back in a moment." He was friendly. He was someone I knew. He came back with a smile and told me their fund manager had achieved over 20% the previous year. The best in Greece, he said. Then he handed me a leaflet dressed like a book. His bank's own funds, page after page. I walked out. But I want to be honest. I'm not sure I walked out because I was smart. I walked out because I was confused. And confusion is a thin shield. The next person who comes in more confident, with a better chart, might get through. It took me 3 more years to find Graham, and when I did, I understood exactly what happened in that bank. A friend recommending a product is still someone recommending a product. A leaflet dressed like a book is not education, it is a sales pitch. The only way to tell the difference is knowledge. That is why you are here. And not just for yourself, for everyone who will one day ask you what to do with their money. A child, a partner, a friend standing in a bank about to take a leaflet. If you want to keep building that knowledge, subscribe. Every video in this series is the book I wish someone had handed me that day. Not a leaflet, the real thing. Pass it on. On page 236, Jason Zweig writes something worth taking seriously. Intriguingly, the disastrous boom and bust of the 1999 and 2002 also came roughly 35 years after the previous cycle of insanity. Perhaps it takes about 35 years for the investors who remember the last new economy craze to become less influential than those who do not. If this intuition is correct, the intelligent investor should be particularly vigilant around the year 2030. In 2000, the dot-com bubble collapsed. Trillions wiped out. Companies with no earnings, no products, and no customers had been valued higher than the largest corporations in America. And then it ended. The investors who lived through that, who felt it, who lost money in it, carried the scar. They remembered, and that memory made them cautious the next time someone promised them a new economy. But memories fade, and people who carry them retire, or die, or simply become less influential than the generation that comes after them. A generation that heard about the crash but never felt it. A generation for whom it is history, not experience. That generation is investing right now. Think about what they have actually lived through. No crash since 2008. 17 years of our market that, with one brief exception in 2020, went in one direction, up. The investors who are 30 today were 13 when Lehman Brothers collapsed. They did not feel it. They read about it. What their entire investing life has taught them is that markets recover, technology wins, and the number goes up. They are not wrong that markets recover, but they have never held a position through 3 years of losses with no certainty of the other side. They have never felt what Graham called calamitous. Zweig wrote this warning in 2003. We are now in 2026. The cycle he described is not approaching, we are inside it. Graham closes chapter 9 with that. It would appear more logical for the typical investor to make his bond-type investments directly, rather than to have them form part of a mutual fund commitment. The better choice for the bond component will be the purchase of United States savings bonds or corporate bonds rated A or better. You don't need a fund for everything. Think about what you are actually paying for when you buy a bond fund. A manager, research, administration, a fee every year on the simplest part of your portfolio. Bonds are not complicated. They pay a fixed rate. They mature on a fixed date. You know exactly what you are getting. There is no skill required to hold them, and therefore no reason to pay someone for that skill. Graham's rule is simple. Use fund for stocks. Stocks require judgment. Which companies, which sectors, which prices. That judgment is worth paying for if you find someone who has it. And if you cannot find that person, an index fund does the job at minimal cost. Do not use a fund for bonds. Buy them directly. In Graham's time, that meant US savings bonds or corporate bonds rated A or better. Today, the same principle applies. Government bonds, high-grade corporate bonds, or a simple treasury ladder you build yourself. No manager, no fee. No middleman between you and a fixed return. One decision for stocks, one direct purchase for bonds. That is the whole structure. And here, Zweig steps in and he introduces a tool that did not exist in Graham's time. An index fund, which owns all the stocks in the market, all the time, without any pretense of being able to select the best and avoid the worst, will beat most funds over the long run. Hold an index fund for 20 years or more, adding new money every month, and you are all but certain to outperform the vast majority of professional and individual investors alike. In other words, stop trying to pick the winner. Own everything, every month, for 20 years. The index fund does not try to beat the market, it is the market, and that, it turns out, is enough. Some of you will still want a manager, and that is fine. The mistake is not wanting one, the mistake is choosing one the way most people do, by looking at last year's returns. Zweig shows you the opposite way. Most fund buyers look at past performance first, then the manager's reputation, then at the riskiness of the fund, and finally, if ever, at the fund's expenses. The intelligent investor looks at those same things, but in the opposite order. Since a fund's expenses are far more predictable than its future risk or return, you should make them your first filter. Start with costs, not returns. Costs are the only number that is guaranteed. Returns are a promise. Expenses are a certainty. Once you have filtered by cost, Zweig tells you what to look for next. Find a low-cost fund whose managers are major shareholders, dare to be different, don't hype their returns, and have shown a willingness to shut down before they get too big. Then, and only then, consult their Morningstar rating. Managers who own shares in their own fund have what Nassim Taleb calls skin in the game. Managers who dare to be different are not just following the crowd, which means they have a chance of beating it. And a manager willing to close the fund to new investors is putting performance ahead of profit. That is rare, and it matters. But even if you find that fund, knowing when to sell is just as important as knowing when to buy. Zweig gives you 4 red flags. A sharp and unexpected change in strategy, an increase in expenses, suggesting that the managers are lining their own pockets, large and frequent tax bills generated by excessive trading, suddenly erratic returns. None of these are about price. A falling price is not a reason to sell. These are. They signal that something structural has changed, that the fund you bought no longer exists in the form you bought it. And finally, the most important quality any fund investor can have. If you are not prepared to stick with a fund through at least 3 lean years, you shouldn't buy it in the first place. Patience is the fund investor's single most powerful ally. 3 lean years, not 3 bad days, not 3 bad months. 3 years of watching a fund underperform while everyone around you chases something shinier. That is the price of admission, and most investors are not willing to pay it. The ones who are the ones who win. So here's the bottom line. Wall Street is always going to try to sell you a miracle. They have been doing it since time immemorial, and they aren't going to stop now. But this brings up a massive question. If we shouldn't trust the miracle workers managing the funds, who should we trust? The reality is that almost all investing is based, to some degree, on advice we receive from others. We are mostly amateurs, so we naturally look for professional guidance. But as Graham warns, it is naive to expect an advisor to just make money for you. That is your own job. An advisor is meant to be a shield against mistakes, not a magic wand. In the next video, we are going to look at the person sitting across the desk from you. We are diving into chapter 10 to see if your advisor is a true professional or just a salesman in a nice suit. Click here to head into chapter 10, The Investor and His Advisors. I am Nick, and I'll see you in the next one.